Welcome to Views from the Top, Livewire's long-form video series bringing you closer to the best investors in the world. I'm Hunsley, and our guest today really needs no introduction, but we're going to give him one anyway. Christopher Joye is the Chief Investment Officer and Portfolio Manager at Coolabah Capital Investments, and apart from managing over $10 billion in funds under management, Chris also happens to be the fourth most followed contributor on the Livewire website. Today he's joining us to share his views and discuss what he is seeing in markets. Chris, it's a real treat to chat to you today. Thanks for joining us.
Fourth?
Yeah.
Really?
Fourth. There's three more places to go, sir.
This is true.
Good to have you with us. Just given the timing of when we're doing this interview, I thought we could talk about performance in the last 12 months just to start with. Two of Coolabah's funds, the long-short credit fund and the floating rate high-yield strategy, returning 11.86 and 12.11% respectively over the past 12 months for institutional investors. And you've achieved those numbers with a strategy that I'd argue is, if it's not rare, it's unique, certainly compared to your peer group. Can you just start by explaining that strategy and what makes it different?
Yeah, thanks, Hans. And both those funds actually topped their Morningstar universes, so the unconstrained fixed income universe and the short-term fixed interest universe. I think what makes those strategies different is we're not hold to maturity. We're not passive. Most bond fund managers hold their bonds to maturity and they're chasing yield. And to get more yield, you have to take more risk through illiquidity in private debt, default risk, private debt and high yield, or you can make big interest rate bets. And we don't do any of those things. So we're hyper liquid. We don't take any interest rate bets, so we're floating rate. And we don't take really any default risk. We're typically A to AA rated. What we do is look for mispricings in the bond market. So we tend to hold for very short periods of time. We typically have around 200 active positions, and we're actually focused on capital gain as well as yield. We're trading about 500 mil to $1 billion a day. So in the last circa 7 months, we've bought and sold over 80 billion of bonds globally. 2/3 of that is typically offshore, 1/3 is onshore. We're much more like a value-based equity stock picker. If you were a Buffett acolyte, you'd be looking for a cheap stock, trading on a high dividend yield, hoping to get capital gain, and when it appreciates, the yield comes down. Similarly, in the bond market, we're looking for a bond paying 6.25% that should only be paying 6%. And as that interest rate comes down, we get a capital gain. And we're doing that all day, every day, in very safe, very liquid credit, not chasing yield or risk, really looking for those total returns.
Yeah, no, absolutely. So when you talk to those mispricings and all the trades that you make every day, I'm curious, can you illuminate our audience to maybe some of the tools, the data, and the research capability that you use to create that investment engine?
So we have the largest team in high-grade fixed income in Australia, almost 50 staff with 11 traders and PMs, 15 analysts. And as you intimated, we require an enormous amount of data and analytics. So we actually use up to 80 proprietary bond pricing models that we've built in-house. And if we're pricing any given bond, so for example, a few weeks ago, ANZ issued a bond, a Tier 2 bond here in Australia that was about 13 basis points cheap to fair value on our estimates. And we would have used 15 to 25 different models to price that bond. But within the business, we have 9 guys in London, 4 traders in London, 5 analysts in London. We're about to open up a Miami office. We have the team spread across Sydney, Melbourne, Auckland, obviously London and shortly Miami. And then within the management architecture, we have a dedicated data science team. So we have 7 data scientists, and we have a dedicated credit research team, 7 credit analysts, and we have a dedicated macro research team. And then the 11 traders and PMs are all quants generally. So we consume huge amounts of data from all over the world live with API links into our systems. We actually do a ton of software engineering ourselves. So we have 7 software engineers and we build all of our own technology. So we don't really like to rely on anyone else's models, anyone else's tech, and anyone else's IP.
So in other words, you are the epitome of do your own research.
Correct.
And build everything yourself. All right. Well, I know that your strategies don't necessarily hinge on the day-to-day macro, but I know you've got some big views on the macro cycle, so we can't not ask you about that. And let's just start with this. You have said that a soft landing is still not a guarantee, primarily because we haven't had a landing at all. So as it stands today, and I'm going to preface this for the audience by saying we are taping this interview before the second quarter CPI and before the August RBA meeting. But as it stands today, what probability would you assign to a soft landing, a hard landing, and indeed a no landing?
Well, I think we'll have a landing one way or another, but I think a harder landing is more likely. And I think you really hit the nail on the head, Hans, when you said that we haven't had a landing. This is a point we've been making relentlessly. Everyone's talked about this soft landing narrative. It's been the dominant intellectual idea for the last year or two. But we've pointed out you can't have a landing if you haven't got price stability, if you haven't hit your inflation target. And we haven't hit our inflation targets. We're nowhere near hitting them right now. And New Zealand's in recession, and they started lifting rates way ahead of most of the world in October 21. The RBA didn't start until May 22. And they're in recession. They've had a big increase in unemployment. And I would say generally around the world, what we're observing right now, Hans, is sticky services inflation. In some countries, we're seeing a re-acceleration of that services inflation. And arguably, we think we're heading into a stagflationary climate. Now, the US has had 3 pretty good months, still above target months of inflation, but the first 3 months were terrible. And on a 6-month annualized basis, the US inflation data is still terrible. I think the Fed is imprudently thinking about cutting rates in September and probably will cut rates in September. That seems mad to me because if Trump wins, you're going to get a radical regime change in the US economy. It's going to be completely different. You're going to have a massive reduction in immigration. You're going to have tariffs on all Chinese imports, which is highly inflationary. And you're going to have tax cuts, which is going to further blow out one of the biggest budget deficits we've ever seen. So why the Fed wouldn't wait a few months to get that new information, I have no idea. And you also hinted at the Aussie CPI data. Now, as you say, at the time of recording this, we don't know what it's going to be. But I can tell you what the RBA is forecasting. They're forecasting 0.8%. We're forecasting 1 to 1.1% for the quarter. By the time you're watching this, you'll know what the data is. The RBA is desperately keen to avoid hiking because they'll look really silly if they hike when the rest of the world's cutting. But the truth is they're way behind the curve. Our cash rate at 435, way below the rest of the world at 500 to 550. So in short, I think the only way to tame inflation, Hans, is through weaker demand, weaker growth, higher unemployment, weaker wage growth.
You say that a hard landing, there's a bigger risk of a hard landing. Would you be prepared to put a percentage on that, the risk of a hard landing compared to a soft landing?
I would say 70% plus probability of hard landings around the world. I mean, we're already getting hard landings, arguably in the likes of the UK and New Zealand. Open question is, do we get a hard landing in the US? It would be a miracle if we didn't get a hard landing in Australia in order to resolve our inflation crisis. You
mentioned the Reserve Bank. Let's go there. You've been openly critical of the Reserve Bank, saying it's undershot its own models. As you say, 4.35%, well below whether we are compared to our developed market peers, a lot of them 5%, 5.5%, as you say. And I love this term. You've argued that they will be humiliated into a second round of rate hikes. Now, if that were to eventuate, possibly starting as soon as August, what should investors be doing right now to prepare for that scenario?
Yeah, so the key recommendations, obviously I can't give personal financial advice, but my key recommendations to myself for the purposes of the conversation are, you want to be liquid. You want to move up the capital stack. So you don't want to have any exposure to anything that's cyclically sensitive, anything with default risk. And you really want to avoid illiquidity like the plague. So the asset classes for me that spring to mind are venture capital, private equity, commercial real estate, private debt, high yield, bonds. Anything that's liquid won't reprice. And what we are seeing right now is a tremendous shift in the economic regime. We've been in a low rates for long paradigm for many years since 2008, and we've moved into a high rates for potentially long regime. And that's going to force a repricing of a lot of assets. But a lot of assets haven't repriced. It was interesting, Hans. PIMCO, just over a few weeks ago, came out and they said 40% of all private debt borrowers can't repay their loans. And crucially, and I think this is interesting coming from PIMCO because they run private credit strategies, they said the return you're getting on private debt is less than half what you should get as a minimum from private debt. So that's a great example of stuff not repricing, given we're facing the biggest interest rate shock and the biggest inflation shock in decades. And my view is it's going to be a multi-year adjustment process. Remember, and we've been talking about this for years, Hans, but we had an inflation crisis clearly in 2021. Yeah. We're now in 2024, we still have an inflation crisis. Yeah. So liquid, up the capital stack, avoid default risks. And then I do think at some point, if you're running a bond portfolio, 75% of my money is floating, 25% is fixed. I do think averaging into fixed rate bonds at some point or taking so-called duration exposure makes some sense.
So you talked about private credit there. You were referencing the PIMCO data. Let's go there. You have been outspoken on the rise of private credit. The last time you were on the Rules of Investing podcast, you said that most managers will likely not survive this cycle. So from your perspective, where do you think we're at now? And do you still think that most managers will likely not survive this cycle?
100%. And you know what, while we're talking about it, I'd challenge Andrew Lockhart, who's the 500-pound gorilla of the private debt space, to an open debate on liquid...
Metrics Credit Partners, yes.
Yeah, Metrics Credit Partners. I'll challenge Lockie to an open debate on liquid versus illiquid credit, if he has the kahunas to go toe-to-toe with the liquid guys in the form of yours truly. But yeah, I mean, private credit's a disaster, mate. I'm going to give you an example. My mum, her advisor put $250,000 of her money, I won't name who they are, but I think they do feature regularly on the Livewire website, into a private credit shop, right? Run by a manager that is well known. And these dopes put most of the fund into a loan to a marijuana business. And this was years ago. The fund froze, there were redemptions, and my mum's 250 grand is sitting there on her monthly reports basically as a zero. She's never going to get it back. And the problem with private debt is most teams are tiny. Most teams have zero experience running money in a default cycle. Why, Hans? Because we haven't had a default cycle in Australia since 1991, right? And you've basically just got this massive wave of Ponzi-style money chasing yield. And it worked when rates were zero. It worked when there were no default risks. So what the private credit industry is hoping for is deep rate cuts to bail them out. Here in Australia, we've already seen disasters. Bonds are blowing up, Genesis Healthcare, HealthScope, Public Hospitality Group, all financed by non-bank lenders. And if you look at the data, mate, as we do, and you look at the default rate on non-bank loans in Australia versus bank loans, huge gaping chasm. Non-bank default rates going through the roof. Why? Because these private credit guys are completely unregulated. It's the Wild West. Whereas bank arrears, because the banks are incredibly conservative and risk averse, bank arrears have been benign. Now, all of this is juxtaposed against the fact that insolvencies in Australia, in terms of the number of businesses going bust each month, are the highest in 25 years. If you abstract away from Australia, if we zoom out to the global default cycle, this is another key prediction we've made on Livewire's pages many times. We've said we think globally we'll have the worst default cycle since the GFC. We're already tracking to the second worst default cycle in high yield bonds since the GFC. And it's unlikely to get better. Whilst we may see rate cuts, Hans, we think the magnitude of those rate cuts will be very shallow because we think neutral interest rates have drifted higher and we think it'll be a stop-start affair. We don't think it's going to be easy to get inflation back to target. Now, we could be wrong, but at this point, all the data suggests we're likely to be right.
Well, I hope for your mum's sake that she does get her money back. But for the institutional investors who are out there, I know private credit's not something per se for retail investors just yet, but for the insto investors who bought the marketing, who bought the flashy yields that are available, if they're in it now, should they now just be saying prayers?
I think if you can get liquidity in private credit right now, I would be looking for the exits because a lot of these guys are not going to report their defaults. A lot of these guys are not going to write down the loans. And so the net asset values, the risk is that they're wrong. And I think it's sobering here. I might sound a little bit hyperbolic when I'm challenging, Lockhart and Metrics to an open debate. But the reality is last week, ASIC announced a wide-ranging investigation into private debt because they canvassed the fact that they're worried about the valuations being correct, they're worried about the transparency and the disclosure of defaults, and there's no mandated disclosure at all. So what these funds do is the minute a borrower gets into trouble, they extend and pretend. You have to repay a loan next week, no problem, it'll become a 5-year loan, no default, no worry. And I think that's an issue, and people have loved the lack of volatility. They've loved this straight line as they've seen their unit price appreciate over time. But I think we're going to find that the reason banks don't lend to these borrowers, Hans, and the reason banks don't have problems is because they're subprime borrowers. And one of our views is we had a subprime crisis in 2008 and the banks blew up. And when the banks blew up in 2008, the regulators came along and said, taxpayers have had to bail you out. You've got to stop lending to businesses that can't repay loans. You've got to stop lending to households that cannot repay loans. And where did all those borrowers go? If the banks weren't providing the money, they went into the non-banks. So the non-banks, which are the private debt funds, welcomed them with open arms. In Australia, though, Hans, we didn't have, for all intents and purposes, a private credit industry in 2008. So all these managers weren't around in the crisis in 2008, and they have no collective corporate memory of how to deal with adversity and stress. Now, there are a few exceptions. I will say that I can't generalise and tar everyone with a negative brush.
Of course.
So, the likes of Metrics et al., are much more credible professional organisations. But I just think, every man and their dog is setting up a private credit shop, and most of those guys are going to disappear.
Chris, we've been talking a lot about the right now for markets, including in this private credit space, what's happening right this second. But if we look a little further out, let's say 2 to 3 years out, what do you think will be the biggest opportunity and what will be the biggest risk?
I think it all hinges around where long-term interest rates are going. If we're going to stay in a high rates for long environment, it's going to fundamentally force a re-engineering of the economy. And I think as investors, we want to look for those businesses that will survive and indeed thrive in a high cost of capital climate. Conversely, we want to try and flee those firms that predicated their finances on the low rates for long paradigm, on this idea that money would be perpetually cheap, and there are many firms. So I think we've talked about this before. Our systems track the proportion of listed companies that we classify as zombies. And a zombie company is a company that doesn't have sufficient profit to repay the interest, not the interest in principal, just the interest on their debt. And we've seen in Europe, the US, UK, and Australia, the share of listed companies that fall into the zombie category has lifted over the last decade or so from about 5% of firms to 10 to 15% of firms. And the key areas or the key sectors that feature the largest share of zombies within their industry sectors are sectors like healthcare, real estate, tech, consumer discretionary, and resources. So I think they're the areas you've got to be careful of. And you want to think about your own portfolio. How is it going to perform if interest rates remain persistently high?
Chris, this has been a fantastic conversation. And as I said at the beginning, it's part of a series we call Views from the Top. And your background is certainly deserving of this series. As you say, co-founded Coolabah in 2011. You worked at both the RBA and Goldman Sachs before that. And you studied at Cambridge as well. I'm curious, for somebody with your experience and all your time in markets, what is the most important thing you have learned in that journey? And how do you use that as an investor moving forward?
Yeah, I think the key for me is a few principles. The first is to constantly evolve and adapt. We talk about internally constantly iterating. And so we're trying to learn by doing. Everyone makes mistakes, but you've got to learn from those mistakes and minimize your unforced errors. I think a lot of people are not evolutionary. Most people find it very hard to change. I think that's also true of investment styles. You often hear, stock pickers talk about, I'm a small cap guy. I've done it for 25 years. I've got my process. It's not going to change. It is what it is. We're much more evolutionary. We're looking for new sources of alpha. I think a second key principle, which might sound somewhat paradoxical given my public visage, but is intellectual humility. So intellectual humility is really, really key. And in our business, because our holding periods are measured in hours or days, the market's the ultimate arbiter. And we're just trying to crack the code or solve problems in terms of asset pricing. We're trying to figure out what's the right interest rate for a bond to pay us. And we've learned over time that when we're wrong, and for whatever reason the market doesn't agree with us and the bond doesn't reprice, much better to kind of cut our losses, move on, iterate, and try and tackle the next asset pricing problem. And then I think the final principle is just never accepting the conventional wisdom or the status quo. Now, this is interesting for me because within the conventional wisdom is often a lot of signal. Like, the collective wisdom of markets is a formidable adversary. And as an active manager, when we're looking for mispriced bonds, and our hit rate's about 80 to 90% across more than $250 billion of bond trades. But the reality is we're going to get some right, some wrong. Hopefully, more right than wrong. But we need to constantly have the conviction to ferret into research and ideas and asset pricing problems and really peel back that conventional wisdom. And I think that's one thing we've been very good at doing over the years. Even if we know nothing about a sector or an idea, we'll throw a lot of intellectual horsepower at it and try and pull back the layers of the onion and look for new insight. And I think that's a very, very intellectually cathartic process and incredibly potent and powerful.
If you haven't read it yet, Howard Marks wrote one of his cherished memos recently on the subject of intellectual humility, and I really, really recommend that you all read it. Chris, I very much hope we will get to do this again soon. Andrew Lockhart, if you're out there, come join us for a great debate. We'd be very thrilled to host it at Livewire, and thank you for joining us today. Really appreciate it.
Thank you, Hans.
And thank you for joining us. If you enjoyed that interview, and how could you not have, please subscribe to both the Livewire and Market Index websites, as well as our YouTube channel, where you can find more interviews from our series, Views from the Top. Thank you for joining us, and we'll see you again soon.